Welcome back to the deep dive. Great to have you with us again. Our mission, well, it's simple really. Cut through all that noise, dive into some fascinating sources, and pull out the key insights for you. We try to make complex stuff clear, maybe even actionable. And today, we've got a really interesting deep dive lined up. The insights are courtesy of Nutstuff Research. Don't let the name fool you. Their analysis is seriously sharp. They've given us this amazing collection of ideas. It spans geopolitics, global markets, some specific stock thoughts, and honestly, some pretty mind-bending stuff on the future of finance.
Yeah, what's really compelling is how it all connects. You look at Chinese consumption, then jump to Brazilian politics, then U.S. debt,
Right.
and then the impact of digital assets. It seems scattered, but it actually weaves together this bigger picture of, well, major economic and societal shifts happening right now.
Exactly. So think of this as your shortcut. Get up to speed on these critical topics. We think there are some surprising facts and connections in here that'll really stick with you. Okay, ready to jump in? Let's kick things off with the first big theme: geopolitics. It's always amazing how these underlying shifts can just completely change the market story, right? And we're starting with China.
Indeed. And one of Nutstuff's go-to China sources, Louis Gave, he's got this powerful counter-narrative. He's arguing the China bull market isn't over. Not by a long shot. It's going to continue.
Which flies in the face of that whole U.S. exceptionalism thing, doesn't it? Especially after China was called uninvestable.
Exactly. That narrative really took hold, post-Russia's invasion of Ukraine. Taiwan worries.
Yeah.
But Gavia challenges that. And he directly tackles this idea that China doesn't consume.
Ah, yes, you hear that one a lot.
Right. But he points out, look, no major country has seen its standard of living rise faster in the last 25 years. Think about the scale. China's now the biggest market for cars, for luxury goods, for tourism, beef, fish, electricity, smartphones. The list goes on. And the key thing, this was basically nothing 20 years ago. It's incredible transformation.
That's a really important perspective.
And it makes you ask, well, why don't we say India underconsumes? Or Africa? Their consumption levels aren't even close to China's. It feels like a bit of a double standard.
Fair point.
And here's another fascinating angle: healthcare costs. In China, you're not looking at $15,000 for stitches or $50,000 for an appendectomy.
Good grief.
Or $30,000 per person for health insurance. That frees up a huge amount of disposable income for Chinese households, which, fuels that consumption we were just talking about.
Wow, those healthcare cost differences. That's a massive factor. I hadn't fully grasped how much that shifts the household economic picture. Definitely puts things in perspective.
Yep.
Okay, so let's pivot a bit. Brazil seems maybe a bit disconnected, but the sources highlight some really significant political and economic stuff happening there. We're even seeing it reflected in charts like EWZ-US, the Brazil ETF, and Mercado Libre, MELI-US.
Yeah, Brazil's definitely one to watch. There's a key political development brewing. Tarcísio, he's center-right, was infrastructure minister under Bolsonaro, now the governor of Sao Paulo state, and pretty popular. He's apparently planning a presidential run.
Okay.
And you've got this powerful congressional bloc, the Centrão, looking to align with him, potentially with Ciro Nogueira as VP. Now, if Bolsonaro gives Tarcísio his blessing, or maybe suggests his son, or even his wife Michelle as VP, well, the Centrão would likely jump right in.
So a lot of moving parts there.
Very much so. And the sources mentioned that Brazilian deep state is kind of nudging Tarcísio to run. That's
Right.
Well, that's a powerful signal. There's a timeline, too. He needs to leave the governorship by late September 2025 to run in the October 2026 election.
Right.
There's even speculation, though it is speculation, about a Tarcísio plus Michelle Bolsonaro ticket winning big. And what's also interesting is the current president, Lula. His popularity has been dipping. There's talk he might not even run again. A recent poll actually put Tarcísio 12% ahead of Lula in a potential second round.
So Lula might just step aside.
It's possible. If he thinks he might lose, maybe he just retires by September. It's a really fluid situation.
Okay, a complex political dance in Brazil. So how do these shifts, China's consumption, Brazil's politics, how does this all tie back into the bigger market trends, the global economy? Let's move on to the markets section now. The sources acknowledge, the macro picture looks a bit weak, maybe weakening, and the U.S. market feels expensive, right? But, as they always say, you buy stocks, not the whole index.
And a really key forward-looking point from Nutstuff is this idea that the second half of 2025, That's probably when we start hearing talk about Project Zimbabwe again,
Mm.
or MMT, modern monetary theory.
Right, Project Zimbabwe, that's the hyperinflation scenario.
Yeah.
And MMT is the just print more money idea.
Essentially, yes. And it connects directly to the U.S. fiscal situation.
Mm.
Ray Dalio's breakdown of the U.S. budget bill. It's pretty sobering.
What's he saying?
Well, he projects U.S. government spending around $7 trillion a year, but inflows, only about $5 trillion.
Oof, big gap.
Huge gap. And that means the debt, which is already, what, 6 times the money coming in, 100% of GDP, about $230,000 per family, is set to balloon over the next decade. We're talking maybe 7.5 times inflows, 130% of GDP.
Yeah.
That's like $425,000 per family.
Wow, those are staggering numbers.
They really are. And crucially, interest and principal payments on that debt could jump from around $10 trillion now to maybe $18 trillion. So Dalio lays out the choices, and they're stark. Either, massive spending cuts and tax hikes we can barely imagine, or a lot more money printing, devaluing the dollar, pushing interest rates down to really unattractive levels. His conclusion is basically rinse, wash, repeat, more fiat printing, more devaluation, which logically leads to more demand for hard assets, things of limited supply.
That's a powerful and, yeah, frankly, slightly worrying forecast for the U.S. fiscal path. So connecting this back, what does it mean for actual power dynamics? Things like tariffs, supply chains.
Right, because this raises a critical point about limitations. The U.S. can print dollars, the Fed can set rates, but they can't print rare earth magnets.
And China dominates those, right?
Absolutely. China has this quiet chokehold on rare earth magnets. And these things are essential for EVs, missiles, drones, AI chips, basically modern technology in defense. The sources call it supply chain deterrence.
Supply chain deterrence. Interesting phrase.
Yeah. It means Beijing's quiet grip on U.S. defense, on wider industry. It's real. And it's just part of this 200-year mean reversion of China's share of global GDP.
Yeah.
That trend just keeps going.
Okay, moving from the big macro picture, let's drill down a bit. How does this translate into specific investment ideas or sector trends that Nutstuff is highlighting? Let's unpack some of those stock and sector ideas.
Sure. So in the stocks and ideas section, they flag several interesting plays. Often high risk, high reward. For example, Tungsten UK, that's TUNLN. They just raised another £4 million. Their total convertible loan notes, or CLN's debt that converts to shares later, are up to £29 million.
Okay.
And the key thing for investors there is the conversion price was set at 3 pence per share. That's a benchmark, sets up potential upside if they execute.
Got it. What else?
Then there's ATMLN. They just got $50 million in financing. Market cap's only $27 million right now, but they're targeting $60–70 million in earnings before interest and taxes, and looking to raise a much bigger $630 million down the line.
Ambitious.
Very. A new position they mentioned is ENVX US. That's battery tech. Big potential, $2.1 billion market cap, but they clearly flag it.
Right.
High risk, high reward. Also some speculative situations like Mesoblast, Mero, potential $6 billion valuation versus maybe $1.2 billion now. And Cardiol, CRDL US, keep an eye out. Yeah. Results for acute myocarditis are apparently imminent. Could be a big deal.
Okay.
And for offshore drillers, specifically Valaris, VLUS, they just locked in a new 2.5-year contract. Great day rate, $410 K. Plus, Turkish Petroleum is buying 2 rigs.
The demand is strong there.
Exactly. It signals supply is tightening up in that sector. That's bullish for the whole offshore drilling industry.
Right. Okay, let's pivot now to AI CapEx. That's obviously a huge theme driving everything.
Oh, absolutely. Chris Wood really breaks this down well. He notes how U.S. market leadership just snapped right back to the AI capital spending story. And it's crucial to understand the recent tax changes here.
How so?
Well, the bill allows upfront tax deductibility for domestic R&D costs now, instead of spreading it over 5 years. And it brought back 100% bonus depreciation for shorter life capital spending, like servers and equipment.
So companies can write off those huge AI investments faster.
Exactly. The practical effect is it delays the hit to free cash flow for the big cloud players, the hyperscalers, as they shift from being relatively asset light to making these massive investments in data centers, specialized chips, all chasing AGI, artificial general intelligence.
That hypothetical human-level AI.
Right. And look at Meta. They're being super aggressive. A $15 billion investment for a huge stake in Scale AI, that data labeling startup. And reportedly trying to poach top OpenAI engineers with like $100 million sign-on bonuses.
Wow, $100 million.
Yeah. It suggests maybe Zuckerberg isn't entirely confident his current team can get them to AGI first. The market sees all this massive spending, this AI CapEx arms race, as proof of growth, But, these are huge bets. These giants are stepping out of their traditional territories, their moats, and starting to compete directly with each other head on, really for the first time.
Fascinating dynamic. Now, while AI gets all the capital and attention, the sources also flag some, let's say, less rosy situations in digital assets. Specifically, Helium, the HNT token.
Yes, Helium HNT gets called out. The source uses the term ludicrous valuation at $400 million for the token. It describes the structure as like Siamese twins, codependent, but one is drinking 85% of the milk,
Mean me.
meaning there's very little actual mobile revenue going to the HNT token itself. Most of the revenue goes to Nova Labs, and Nova Labs is also the biggest buyer of the HNT token.
So it's kind of propping itself up.
That's the concern. The source calls it mad and totally unsustainable and expect it needs to get fixed. It raises big questions about the model's long-term viability.
Okay, that's a clear warning signal there. Are there other areas or themes mentioned in the stocks and ideas section?
Yeah, a few broader ones. Things like digital assets and tokenization generally, mentioning Robinhood, Hood US, MicroStrategy, MSTR US, Bitcoin Treasury plays, SBET US, also EU defense, highlighting Leonardo and AVIO. For China exposure beyond the macro, KWEB US is mentioned, plus some single stocks and Hong Kong real estate plays.
Okay.
Others include Plus 500 in the UK, RWE in the EU, Mercado Libre, which we mentioned in Latin America, and then specifically UK North Sea and Energy, JOG LN, Keystos, and this new one, Heart's Head UK Australia, listed. Described as fascinating, maybe even a 10x potential if their North Sea exploration call is right.
A potential 10-bagger always catches the eye.
Always does. And finally, PMPNCN gets an update. See $2.28 per share valuation target, suggesting like 104% upside if their drilling continues to deliver.
Okay, quite a range of ideas there. Now let's shift gears again, moving beyond specific stocks into something, well, maybe more profound. The think about this section. This is where things get really interesting, starting with Bitcoin.
Yeah, the perspective on Bitcoin here is, well, it's different. The source says, Bitcoin isn't based in Silicon Valley. It doesn't wear Patagonia vests or answer to LPs. It doesn't beg for capital. It earns. It waits. It simply holds.
That's quite poetic, almost.
It is, and it goes on. Think of it as an IQ test wrapped in a Ponzi accusation, disguised as a protest, fueled by memes, hated by economists, revered by a dedicated community, backed by mathematics, powered by entropy, and holding a mirror to the spiritual decay of a fiat civilization.
Wow, that's a lot to unpack.
It really is. The core idea presented is you simply don't buy Bitcoin as an investment. You buy it because you just woke up and realized that everything else is actually just a lesser functioning, out-of-date lie. It's framing it not just as an asset, but as an awakening to flaws in the current system.
A radical reframing, for sure. And when you layer on the supply and demand dynamics, the picture gets even more stark, doesn't it?
Absolutely. Let's just run through the numbers quickly. Total global liquid assets, maybe around $300 trillion ballpark. Now imagine just a 10% allocation to Bitcoin. That's $30 trillion.
Okay.
But Bitcoin's current market cap is only around $2 trillion. And here's the kicker. The total supply is fixed at 21 million coins, ever. Almost 20 million are already out there. The new supply coming online each year, only about 0.8%.
So the math just doesn't work, does it?
Not easily. The fundamental question is, how do you possibly squeeze $30 trillion of demand into a $2 trillion asset with almost no new supply coming without the price going up? A lot. The simple answer is, you can't.
And that feeling, it taps into something broader, doesn't it? The sense, especially among younger people maybe, that the entire system is broken.
It really resonates with that. The source points out that many people, particularly younger generations, feel like traditional finance, traditional media, traditional everything. It's either failing them or actively working against them. There's this quote about how buying a house feels impossible, so people just buy a ticket for Glastonbury and Rebel.
Right, sort of opting out.
Or building around it. Instead of fixing what's broken, it's like a whole generation is saying, screw it, we'll build our own. That's why you see people working remotely. 19-year-olds building AI apps instead of chasing Wall Street jobs, bootstrapping online businesses instead of climbing the corporate ladder.
It's a different motivation.
Totally different. It's not just about being cool or getting rich. It's born from genuine frustration with how broken things feel. That's a really powerful driver for innovation, for building alternatives.
So with that frustration as a backdrop and this drive for new solutions, what does it mean practically for how people actually manage their money day to day?
Well, it points towards a massive shift. Look at banking. Young people are already ditching the old guard, Barclays, HSBC, for slick apps like Monzo, Revolut. So the question is, why wouldn't they do the same with financial products?
Makes sense.
If you can swap a traditional bond fund earning maybe 4 or 5% for a crypto stablecoin yielding 10% or more, well, the choice seems pretty obvious, especially if you've already lost faith in the old system. The perceived risk might even look different to them.
And it's not just the yield, is it? It's the usability.
Exactly. The efficiency gap is huge. TradFi, traditional finance, it can be such a pain, right? Endless forms, waiting days for approvals, days for funds to clear. Getting money out can take even longer.
We've all been there.
Right. Now compare that to something like Maple Finance's SERP USDC, as the source mentions. Connect your digital wallet, click apply, boom, you're earning over 10% instantly. Need the money back. 2 days. The source asks, why would anyone, especially young people, choose the safer but slow, lower return traditional path when the alternative offers double the returns and moves money almost instantly?
It really does feel like that scene from Highlander, the quickening, a transfer of power of energy from one system to another.
That's the exact analogy Nutstuff uses, the quickening, from fiat government money to Bitcoin. It's described as receiving all the power and knowledge from the old system. The view here is that digital assets, cryptos, stablecoins, they might aptly end up bailing out the traditional system that's choking on debt simply by lowering the cost of capital for the U.S.
Huh. That's a counterintuitive thought.
It is. Bitcoin is framed as this monetary singularity, fixed supply, guaranteed by math and code, not human promises. It acts like a financial black hole, pulling capital away from inflationary fiat currencies.
Okay.
And then there's this really profound idea, the convergence of AI and Bitcoin. The source suggests this convergence will start to destroy the traditional intermediaries, banks, governments, corporations.
How would that work?
Imagine superintelligent AI combined with mathematically sound money that could create an economy of autonomous agents, machines transacting directly with each other on the Bitcoin network, no humans needed in the middle. Trust shifts from corruptible human institutions to cryptographic proof and programmable contracts.
That's a mind-bending future.
It really is. The source concludes that few people are prepared for what's coming. The demand for Bitcoin, especially leveraged Bitcoin, in a real mania phase. It could send asset values soaring in ways most people can't even imagine right now.
And we're already seeing some incredible performance from Bitcoin, aren't we? Especially compared to, say, the US dollar recently.
Absolutely. Bitcoin just hit $116,000. Remember, 10 years ago it was $290. That's a 400x return. Over 82% annualized. It's up 55% just since the lows back in April 2025.
Well, the dollar?
The US dollar just had its worst start to a year since 1973, down 11% in 6 months. The source is clear. This is not a coincidence, and it poses the question. Just imagine owning 0 BTC right now.
Makes you think.
And think about adoption. Over 900 million digital wallets out there. Okay, maybe not all active, but still. Compare that to the fixed supply. Only 21 million Bitcoin ever for 8 billion people. That works out to just 262,500 Satoshis per person, remember. 100 million Satoshis in one Bitcoin.
Scarcity is extreme.
It really is.
Yeah.
And very few people grasp the sheer demand for Bitcoin block space that's now starting to come from traditional finance, from TradFi. The market for stablecoins alone is potentially many, many trillions of dollars, with transaction volumes many times that. And that's just the beginning, before you even factor in all the Web3 applications migrating from Web 2.
So the potential scale is enormous.
Nutstuff still sees a potential path over the next, say, 6 to 8 years for crypto to become a $100 trillion asset class. When you consider the alternative, the fiat rot, as they call it, well, it seems, as the source says, very logical indeed.
Wow, okay. We have covered a ton of ground today, from those big geopolitical shifts in China and Brazil to the really stark macro picture for U.S. debt and those supply chain chokeholds, then into specific investment ideas, AI CapEx trends, and finally this really deep philosophical dive into Bitcoin, digital assets, and how they might just be fundamentally challenging the entire traditional financial system.
Yeah, and the connecting thread through all of it, I think, is this idea of shifting narratives, questioning established systems, and this relentless drive for innovation, whether it's AI or, money itself. The sources really push you to look beyond the conventional wisdom.
Absolutely. So you've basically just gotten a massive shortcut to getting your head around some of the most critical trends shaping, well, the world, your finances, the future.
And maybe one last thought to leave you with, building on that convergence idea. If AI does meet mathematically sound money, and we get this economy of autonomous agents, what does that really mean for trust? What's the role for us, for individuals in a world potentially governed more by cryptographic proof than by human institutions?
Definitely a lot to chew on there. As always, thank you so much for joining us on this deep dive. We encourage you to keep exploring these topics. They're fascinating and they're important. We'll catch you on the next one.
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct. But Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.